Michael, welcome to Trader Roundup. How you doing, sir?
You guys hear me? I'm not even sure I'm connected to this
Yes,
thing.
we can hear you.
Yes,
We can hear
I
you.
can hear you. I can hear you.
Wonderful, wonderful live stream, sir. Excellent.
Thank you. How's everybody doing today?
The facetious tone at the end. Interesting price run. Wish I could have caught it from the bottom. I was literally in tears laughing as I was grabbing my phone to go live. I'm like, that's the funniest shit ever. But anyway, man. Yeah, how great live stream. How you doing?
Seasonal allergies are kicking my butt a little bit, but otherwise I'm blessed. I'm thankful that another day here.
Nice. With the conversation today, clearly we are going to be looking for feedback. So we will be requesting folks as they come up. If they have any notes that they've taken, Pit Munch, I know she's got some notes. So we can go over some notes. I want to request the listener, pretty please, stay focused and try and provide value and, more importantly, feedback on what you learned, what you heard, the importance of tape reading today, specifically the art of, right?
If we could, at least my portion of it, could we keep it to 12:10?
Yes, sir. Yes,
Eastern?
sir. I like it.
Awesome.
Perfect. Sounds good. So, Pit Munch, you're gonna go first, pretty please.
Yeah, I have like 3, 4 things that I can mention out of the notes that were how do you say that that stood out for me. What I liked was how we went into naming it a critical crossroad. Um, we were watching is if it was going to be an inversion or a reclaimed fair value gap. So I like the analogy of a critical crossroad and how you should look at that. And the anticipatory price reading with the analogy of the canary coal mine. I thought that was a good one as well. And the grandma's cookie cutter. Well, it's not the first time that we're hearing about the cookie cutter, but this time it was what appealed to me was the example of if she's using the cookie cutter and she does it wrong, then she's not gonna throw the whole cookie cutter away. She's just gonna use it again next to the one that didn't come out like she wanted. And then applying that to the chart, the PD array, it didn't do what you wanted it to do or what you were expecting, but you're not gonna throw it away immediately. If the logic still stands, you're still gonna watch it and you can still use it. So I thought that one was nice, and the the low getting taken out. I missed the specific word that Michael used, but it was I think it was like it was like prominently when the on the 15 seconds when the low on the left got taken out like aggressively, and he said if you see this, then it's likely a signal that it's gonna go for the opposing liquidity. So I thought that was also a really good signature, that you don't think like, oh, it's going aggressively now, I'm gonna go short. So this is something to keep in mind. And the last thing that I wanted to mention is something that he said it himself. It's not he has said it before, and I think it was with a high like a few lectures ago. But there was a low, and the candle on the left has a low with the wick, but the current candle has a body that's lower than the previous body, so that is the lower low. That's something that I wrote down that I have to keep in mind and start looking for. So those were a few things that I wanted to mention.
Very good, astute observations. Want to continue that same conversation, Johan? Did you have
Yes.
some observations and/or questions?
Yes. So beside that's what Pittman said. I really like the inversion fair value gap entry mechanism. At the high from 10.7, the turtle soup high, the bodies closed lower than the previous bodies, the turtle soup. Yes, didn't even took that high. Then in NQ, there was also the inversion for value gap entry mechanism at a high. And it was the first fair value gap pre-stop hunt and the only fair value gap in that price run at all. So I liked that a lot. Yes, and yeah, the other things Pittman said, I like the lower low with the bodies. And
I like it.
And also, Michael, you showed the 50-second chart and the large busy, I think it was a reclaimed fair value gap you used. This was kind of like the first fair value gap before the stop hunt, but it wasn't busy. It wasn't Sibi. Could that still be? So it wasn't in the leg down to the stop hunt. It was before the leg down. But in the leg down, there wasn't really a fair value gap.
I'm not sure what you're saying. Are you making an observation? Or are you questioning? Like I don't know what you're saying.
So in the violent stop hunt, you said, do you know what I'm talking about? Before it ran up.
Which time frame are we going to talk about? The 15-second or the 1 minute?
Yeah, 50-second. At 10:23. So in the stop hunt, there wasn't really a Sibi because it was nearly an immediate rebalance. But you marked the reclaimed fair value gap, the busy. And I thought maybe that's the first fair value gap before the stop hunt. Because there's no Sibi.
The only fair value gap I had in close proximity in that area was the one I annotated on the 15-second chart at 10, 21, and 45 seconds. That's a buy side and balance sell side efficiency.
Yes. Okay. Thank you.
Okay, I'm liking the questions. We're staying focused here. I appreciate that. Market Oracle. And I'll be bringing in some new names and new folks as well. I appreciate these questions from some of our folks here. Andre, you'll be up next. Market Oracle, you're up.
Can you hear me?
Yes, sir. Go ahead.
Okay, so first of all, new PD array, 2 weeks. We are gonna
Explain
have a
what you
new
heard with the new
array
PD array.
really soon.
Explain what you heard.
So ICT hinted about a new PD array that is not revealed yet, where there were 2 weeks that were joining each other, and we had no bodies in between. So we're gonna have it sometime, I think, in the books. So he's gonna reveal it sometime in the future.
Advanced Hwick theory. Advanced Hwick's application.
We are having a lot of weeks studies over this year, so I'm really excited about that. And these are exciting times, man. And with the feedback, this was really amazing. We had a little bit of high resistance liquidity run conditions during the day, but the way he navigated saw really showed that once we have a narrative in mind, we can dial through that and wait for the right conditions, like stop hunt in today's case. So he really taught how to navigate when we encounter high resistance conditions and price runs out of nowhere. Like there was that 50 handle drop in 15 seconds. He really taught how to navigate these conditions and how they change the narrative and how these things play with the narrative and minds of retail traders.
Excellent
So
point.
overall, this was really good session.
I want to add to what Market Oracle is saying, and that's that, I mean, in my personal opinion, building on what Market Oracle pointed out, was reading price, being actually able to read the tape, understanding how to read the tape, disassociating yourself with the decisions, being capable of reading, you're looking for specific signatures. You're looking to read, literally read, and apply a language and a logic and a narrative. And that narrative is embedded in the mentorship, in all of your understanding, and the reason why you watch it as many times as you do. The breadth of a candle, the logic, being able to read that, being able to apply the logic is what was being done today. Applying the logic, not anyone else's logic. And I think it's very good and we're here unapologetic that we're not using anything but the concepts that you have learned through the various mentorships with core content, period. I mean, yeah, there's the sniper series and the end series and a lot of other stuff as well. But if we're staying focused, you're focused on chronologically core content, 2022 core content, 16, 17, 23, 24, 25, and now 26. And you somewhere in this journey are looking to apply what you're learning,
The
what
thing
you've
is,
learned. Go ahead, buddy.
the thing I really like this year, how we are blending all the concepts together, the core content
Yes.
lessons along with the models. And we don't, what Michael is really teaching is you don't have to fit in one mold. You can carve out your mold as you go. So what he's really teaching is carve out new stars and moons and everything in that mold that we have. So we can have any mold we want anytime we want.
The universal
That's where
trader.
confidence
I
is instilling.
love that you make that point, Market Oracle. I mean, that is, I believe anybody who studies ICT concepts would like to try to become some form of universal trader. That's what you would kind of aspire towards. And that's a very difficult journey, very difficult. And it's very aspirational.
Yes, and being a one-trick pony in these kind of market environment is really hard for someone that is only blinded by retail concepts.
Well,
But
you kind
unlike
of have to be a
ICT
one.
and
You kind of have to be a one-trick pony before you can be a universal trader.
yes, but ICT is really teaching these things to so that we can evolve into it over time.
I love that. Keeping it
So
going.
this kind,
Yes, I see your hand up, Johan. Andre, you're next, and then we'll head back to Johan. We'll bring up double trader. If you guys have questions, Michael is here, but I'm sure he also appreciates the conversation. So if you guys have questions, feel free. It's a good conversation on today's live stream. So Andre, you're up next, bro.
Hello, guys. I just have a question. I saw on the daily time frame, there is in the 4th of February, there is a suspension block that has been rejected today in the.
Okay, wait. You're referencing the 4th of February. If you recall, this morning and the very first emails, or not, I'm sorry, the text, I'm sorry, the tweets that were going out. What were the two arrays very specifically? It was the NWOG and the RTH. Do you recall?
Yeah.
Okay, just to recalibrate, I appreciate your finding other things on other time frames, but we're really focused on this NWOG and RTH within the 1 minute and 15-second chart. Okay.
Okay, right. So my bad. Okay, because I saw that it rejected from there, so I had an.
I value and appreciate that. I do.
All right. Okay, just I'll pass then. I'll pass
It's
the
not.
next time.
It's no big deal, brother. But and yes, I'm sure you're going to find the suspension block. The arrays today, in which we were framing ideas, in which the lecture was around, was the NWOG, as Michael outlined, as well as the RTH gap.
All right. Okay, definitely. Sure. Sorry. Then I pass to the next guy.
No big deal, brother. It's all good. High five.
High five.
It's good
Okay.
that if you're observing that it's still keying off that daily breaker, that the daily suspension block is part of. But to kind of like combat the people that were leaving comments and or sending posts in TradingView or sending me emails or texting me my private phone number that I really don't appreciate. The idea of pushing past all of what's available and just reducing our focus to two primary gaps, that being the new week opening gap and today's regular trading hours opening range gap. I didn't even talk about first presented fair value gap. All we were looking at is liquidity, the inefficiencies that form after the open at 9:30, and developing, because I went in neutral, and you watched how I shifted everything. And I was like, okay, watch this, pay attention that this is problematic, And I personally want to see new week opening gap high get taken and trade higher than that. And we were one-sided in that regard, but still reading it as we were watching it drop down. And I want to kind of like remind everybody, just because I have more to teach, if you have a model that's working for you, try to not to tinker with it. The things that you're doing right now, that's what's earned its place in your utilization as a trader. You're not trying to be talked out of by me to do another model. If you have something that's paying you, it's making money, stay right where you're at. It doesn't mean you can't start studying and learn the other things, but don't tinker with your model. Just keep it the way it is. If it's paying you, if you're comfortable by implementing it, you don't feel like you have to have extra things added to it, that's exactly where you're supposed to be as a trader. It doesn't matter what I teach. It doesn't matter what I bring out there. I could bring all kinds of wonderful things, but none of that should upset your model that's working in your hands right now. Don't even mess with it. Don't touch it. If you want to do a side project and do another model that's something other and apart from that one, there's nothing against that. But today was just to kind of remind the folks that we're saying, like, this is getting to be a lot of stuff. And there was this long-winded post by somebody on X this morning saying, there's an excuse why you didn't do this, and I'm not doing anything except for simplify. Take all the things that I teach, take a selection tool, take a confirmation tool like SMT. It's a confirmation. It's not even all that important, but it supercharges a good trade. And then finding a timing model, and then look for the easiest objective that makes sense to you while framing a low risk opportunity. That's all that you're supposed to be doing. And when you do that, when you use that model of planning and developing a trading model in itself, the recipe for getting to that is a very short list of things to do. And you're not bringing in all kinds of ingredients. I have lots of ingredients. They're flavor enhancers. But you don't need a whole lot of monosodium glutamate, which is a flavor enhancer, but it's not good for you either. So you start adding things that try to bring the taste forward and improve upon it, but you actually bring bad things to it. So what I'm trying to do is say, okay, look, we're going to strip it down to just two plain essential things. We're on a Monday. We have a new week opening gap, and let's wait for the regular trading hours opening range gap and use what's given to me just by that and read every single candlestick and march to that drum. Not require first resistance fair value gap, no reapers, no anything, nothing. Just let's read price action and strip it down, because that's what you're going to be met with when you're brand new. You don't have all the things that's on that YouTube channel understood. Most of you haven't even gone through the entirety of that compendium. So by stripping it down today, I hopefully communicated that you don't need a lot. To start, you just need to know what you're framing your focus in. Where's the price action you're going to limit your focus inside of in the boundaries? And then look for context to develop or have it going into the marketplace. I told you as I developed it from the 9:30 opening, everything's real time. Everything happened as I was feeling it, being led to be, drawing my attention to specific candles, why I should do this, why I shouldn't do that, the logic behind it when I had the time to afford to do it. And you see where we're trading at now. I'm not beating my chest, but I want to see the appreciation of doing this with the least, not requiring having a lot of tools, but still fleshing out the logic real time, why it should do something and why it shouldn't. When you get a run and it stops you out and goes against your underlying idea, the benefit of knowing when a stop hunt occurs and it doesn't continue going in the direction of the stop run, that's manipulation. And instead of fearing that, instead of being willing to throw your model away and go chase something else, oh, this stuff doesn't work. ICT has become the new retail. We focus on the same PD array with the same direction, with the same logic. Everything has to be this way. It colored outside the lines a little bit. On a 15-second chart, it was posting a couple little bodies down in there, but it didn't go to the low of it. That fair value gap did not get violated. The wick is allowed to do that. That's that little mohawk, like when you're cutting grass and you go back over to another new lane, you missed a spot. It only matters to your wife. She's going to say, you missed a spot. You're going to get to it eventually. You could leave it there and cut the rest of your lawn, and you know that you'll run over top of that. But your wife sees that, Everything's got to stop and get that piece. You just left that spot. She's been in the house doing something else. She didn't start cutting an alarm with you. She didn't do anything with you, but she's going to come out and give you instructions on what you didn't do right. Okay, that's what you're inviting. You're inviting extra wives club on social media. You want everybody's opinion invited to what you're doing. In tape reading, you're not inviting anybody. So I like the fact that the students are coming forward and saying they can see things and they're appreciating this and that, and that's wonderful. That's what I'm looking for, because I'm trying to showcase that you don't need a whole lot, and you don't need to know going into the day what you think should happen. Let the price action dictate what the underlying narrative should be, and that's what I'm looking for today. I'm not asking for people to say, "Oh, ICT, you're so wonderful." I'm not looking for that. I want to see, what did you take away from today? Was there a time when you felt that it was a wrong read and you felt rewarded, or you felt like you were being corrected by the price action? Were the model ideas that I teach around the PD arrays, were they being exhibited today, or were they not? That's what I'm looking for. I want to see if people perceived that in the tape reading today, or was this just a whole bunch of nonsense that means nothing?
So,
And if you feel that way, say it. I want to know.
So, Michael, one thing I wanted to bring the listeners' attention to are the tweets that you sent 3 hours ago, and when you were coming to the market and some of the things that you were looking for. And I want folks to look and see how prices played out over the last 3 hours in relationship to not just your live stream, but the things that you were focusing and reiterating on right now, which is, again, this gap risk. And what I don't think a lot of folks understand, and you liked it, and I'd mentioned it, but for me, you were really saying, look at the market conditions and look at the participants and who's getting hurt. Algorithmically, who's getting hurt, and where will there be reprieve, and where will there be further damage? And where we see, again, like the NWOG being filled, that is a reprieval for the bull, as we know. But folks were asking about it earlier, and you constantly provide, and it's the uninitiated who don't see it, but really framing the context of the market with the participants and the conditions. And today it made the most sense, and I'm just reiterating what you're saying and the tweets that you had mentioned earlier. Like the gap risk is a huge deal with a massive range gap that we had. Is there going to be further damage or reprieval to those participants, first off, because that provides sentiment overall, I believe. And then algorithmically, what signatures can we play off of, which you also provide, wholeheartedly. So I just wanted to compound on that and ask that the listener really go back to your tweets as well, Michael, and look at 3 hours ago versus right now versus the live stream. And how did all of these things actually play out versus your narrative, which for me was extremely accurate because of the way you lay it out.
For the benefit of the folks that are going to probably see or listen to this, years from now, what you're saying, I understand exactly what you're saying. That's why I tweeted what I tweeted. But for the benefit for those that are listening to it and watching this at a later time, in your terms, simplify what I tweeted in comparison to what you saw in price actions. That way they understand, and then they can go back and search through the archive of my Twitter space to see if that was in fact true. But from your own words, what did you see me outline in pre-session, pre-live stream tweets, and then by comparison, what we're looking at now?
Am I available to answer this? Do you mind? Or
I was asking you.
Okay, yeah. I mean, the gap risk for me, what you were laying out 3 hours ago was, listen, the market and gap risk is going to be something that we are going to see a lot of. Therefore, we are going to have trapped participants. Therefore, participants are going to be more skittish. You're not going to see as much volume coming in on a market on close, potentially, with the scared participant being underwater the way that they would have been today. So 3 hours ago, when you first said gap risk is a huge deal, and that's what I heard, Michael, when you said that tweet. I'm trying to go back to some of these other tweets that you said. 1 second. I was going off of memory, but I'm going to look at here. Like you mentioned, the importance of the NWOG and of the RTH. So, and then talking about goobers teaching IFEG versus FEGs. What I think is hilarious is how effective both FEGs are as well as IFEGs. So when you're in these huge gaps where we're dealing with large liquidity voids, the idea of both the fill as well as the inversion are going to be commonalities, common mechanisms or signatures within a market maker model, which we're constantly within a range or a gap going to be seeing both. So, and then you mentioned if I wanted to take it higher, opening like it did last night, down several hundred handles, I would scare most bulls and inspire many bears. So
That's
any,
the one I was waiting for.
yes,
That's what I was listening for.
yes, that, and I had to go back and read it because that, I mean, that is, you were trying to let people know the mechanisms and the psychology right there, and that was a few hours ago. And then you look and see what has happened, and for me, that is, for anyone listening, again, I would like to read this, and this was a few hours ago. And a few hours ago, let's see, we're talking about right now, exactly 2 hours ago, price was 200 points lower. So if I wanted to take it higher, opening like it did last night, down several hundred handles, would scare most bulls and inspire many bears. So that was your if then
From a sentiment perspective,
statements.
for a directional position, if you had nothing to go by except for just that, what direction? Because I was placing myself in the seat of the proverbial fill. Okay, if I'm in control of price and I'm making the market, that's not I'm not a dealer. Okay,
Right.
I'm not a large institution or bank or Goldman Sachs. I'm not a market maker for gold or oil. That you're not a market maker. You're a dealer. All trading is not going through just you. Okay, that's the problem when people say I was a former market maker. Not all trades go through that one person. There's other trades that are happening. They're not providing the only liquidity. They're not the only ones that's doing that. That's why it's a facade. And you listen to these assholes claiming I was a former market maker. You're a bullshit artist. You're a dealer. You're a glorified dealer. The real market making is done behind the scenes. It's autonomous now. So we call him Phil. Okay. So Phil is not an actual person. He's not a guy named Phil, but he's a guy that manual intervenes. So if we want to look at the proverbial Phil and say, okay, if he's in control of things and he wants to take it higher, what's the best way of doing that at the beginning of a new week? Gap it extremely lower because it's going to do two things. It's going to inspire bears, make them feel that they're right. If they're holding positions that are profitable, they're going to continue holding it. And they're going to talk about it online and give the idea that they're the only ones making money being short. Think about how many times you're influenced as a brand new trader. When people say, oh, I'm making so much money, I'm holding for this target. But then now look at it from the other side. Anyone that's long, it's bullish. They opened up way under last week's low. No, not the last week's low, the last low on the daily chart. 25,000, what was it, 243 quarter, I think it was. That's what I had on the chart. That's what I was looking at. I like that level. It wasn't the actual low because it was a little bit lower than that one. But I like that because it's low hanging fruit. But by it gapping down like that, that spooks the bulls. It makes them not want to trust anything going long because they have the backdrop of the geopolitical events that's going on. They have this huge gap risk. They're spooked. And now everybody, majority of the time, are sitting there like deer in headlights. They'll just watch it. They won't do anything with it. They won't have a conviction to go higher or lower. They're scared. Both sides are wrecked. So if I want to take it higher, that's the best scenario. And where's higher? Higher than a new week opening gap high. And that's what we're looking at today.
And what's funny, and again, Michael understands, and maybe old heads understand, and maybe some new folks, they scratch their head. But like, I mean, this gap risk that was talked about earlier and how the week opens, there's a huge psychological play algorithmically being done on the charts. And it's not just a psychological play. It's literally, this is a mass impact psychological play on all of the participants. So just being able to kind of absorb and see that psychology, which again, I think Michael has done a great job for newbies that don't understand institutional order flow, IPTA, seasonality, more of the institutional workings and understanding, institutional order flow, month 5 of core content. It's very long. There's a lot there. But if you have no clue at all of anything and you want to start to string and piece it together, I would recommend that you start taking some core content month 5 classes and add that to your series. And then you would understand some of the things that Michael and I are mentioning right now. Okay. Keeping the conversation going. I'm glad I was able to build on to what Mike was saying there. Who do we got? We got, we'll bring up someone new. Going with DJ Nava. DJ, I like the name, bro. Midwestern, Indiana. How you doing, buddy? You're on a muted mic. DJ Nava, maybe not today. Johan's got his hand up. Let's keep it going.
Okay.
Hold up. Yeah, go ahead, Johan.
So
we might have got DJ Nava in after you, Johan. Go ahead, buddy.
So there's times, wick ranges exist in multiple time frames. As example, a discount 1 minute wick at 10 a.m. You don't need a chart for this, but 10 a.m. 1 minute candle. It's from open to low, but if the low stays the same low for the next 5 minutes, then the same wick is also shown on the 5 minute, and multiple other time frames. Is that like an indicator for a high probability wick?
Asking for criterion, Michael, for a high probability wick in range formations.
No. If
yeah, that's the thing, Johan. Are you making an observation or a question? It's difficult. Okay, just so you know, it is difficult when we listen if you're asking or telling us.
Let's say the same wicks range is found on the 1 minute, 5 minute, and 15 minute chart. There's the same exact time. Is that higher probability then? Because it's like wick times 3.
I mean, that sounds to me like you're talking about multi-time frame confluence, which I would think by definition is higher probability, right? We constantly are seeking multi-time frame alignment. So if you can find that on the chart.
What time frame are you referring to as an example that I can see?
No, on the chart you can't see it. It was just made up. Let's say a 1 minute wick. Okay, 10 a.m. 10 a.m. 1 minute candle. It's kept from the 10 a.m. open to the low of the time interval. But the 10 a.m. open stays the same for the 15 minute because it's also opening at 10 a.m. But if the low stays the same from the initial wick, from the 1 minute interval, for the next 15 minutes, then the wick is the same.
Are you referring to the discount side of the candle, the low?
Yes.
I'm not sure if I understand what the value you're seeking or validation, whether or not it's useful or not. I don't understand how you're framing your question, to be honest with you.
Yeah, for what it's worth, Michael.
I can
and
rephrase
Johan,
the question for you. I understand the question. I will try to rephrase it for you.
Okay. I like it.
So what Johan is saying that suppose we have a 1 minute candle that opens up at 10 a.m. It opens at, let's say, 100, goes down to 80, and rises up to 120. All right, closes at 120. So we are looking at a candle that went below open and then went up. All right, and if that low is not visited again in the next 5 or 15 minutes, then that wick of 20 handles become the low of 5 minute chart, 5 minute candle, or 15 minute candle, or supposedly a 1 hour candle if the price doesn't go below that wick. All right, so thank you, John.
That's good work on you. Good work on you guys asking the question. Hopefully Michael understands now. I think it's a little clearer.
Juan, so the question of Juan is, does that wick become a high probability wick because it was the low, it was the wick of 5 minute, 15 minute, or hourly candle? Does that wick become a high probability wick, or there are is any other criteria for you to grade or qualify a high quality wick? Am I right, Juan?
Yeah, you're like a Dolmetscher, right?
I personally don't ascribe a lot more credence to it because it's on multiple time frames. Because what you're describing is the natural order of things with time frames, so it doesn't bring any importance to it. The fact that that low in the open, it would be seen in an hourly chart because that's where the open would be and that's where the low would be. The 1 minute would look that way because it formed there too. So I don't see any kind of greater importance associated with it. But if you study it and you find something, I'd be willing to listen to what it is you describe as a discovery. I personally have nothing in regards to what you're describing.
Okay, that's cool. Thank you. And this is a quick one. Yeah, I don't think we need Dolmetscher. Let's say a discount wick, so wick to the downside is also a discount wick, so below price. Is that like a supercharger? Because you named it the discount wick.
One more time, a little bit slower, please. I'm only able to look at a chart if you're showing me something on my phone. I'm not
Yeah,
away. I'm away from the screen.
he's trying to explain some things from the lecture. I appreciate what he's trying to say. I'm just not sure. To me, just for what it's worth, quickly, you're describing more market mechanisms and things that are mechanics, not always maybe a signature or maybe a tell. A tell is going to maybe provide some form of edge, which the concepts that Michael teaches, that's what they do. Otherwise, they are like in OHLC is like a mechanic, right? It's a mechanism. So, Johan, I believe you're describing several mechanisms, which is why it's a challenge for us to exactly discern what the edge is, right?
I have a good way. A wick to the downside, so a discount wick. If it's also below current price, is it better? Then it's a discount PD array and also a discount wick.
That's important, yes, because you created it, and we're at market price now. So the first thing and you see it in my examples in my live streams, we talk about it when it's forming in the live. You've seen it being implemented during my executions, where I'm highlighting the consequent encroachment. Continuation is validated and qualified when it goes through the midpoint of that on a closing basis. Then it opens up the floodgates for the potential to continue going lower than that. But if it doesn't, it's actually counterintuitive to look for a lower price until that happens. So it can either consolidate or go the other direction. That's how I would use that.
Thank you.
You're welcome.
Great question. I'm glad that got flushed out and wonderful response. That was really, really good for the recording. That was very well done, Johan and Market Oracle. How you guys came together on that to help each other out. So high five. MB, you're up next, buddy.
You're right, Kit. Should I do the protocol?
Yeah, I like
straight.
protocol, and then I definitely like that you not mumble in a muted mic.
Is this all right?
It sounds like you have headphones in.
Is this better?
Go ahead, buddy. Yeah, go ahead and introduce yourself. I can hear you. It's just try and be clear, pretty please.
All right. So I'm from the UK. I've been doing Michael's Concepts paper trading only for around 2 years now. I focus mainly on the 2022 mentorship. In addition, with inversion fair value gaps and relative equal highs, relative equal lows, they're my favourite. And mainly, I wanted to first talk about what you said before. So when I personally, for me, when I go into it, I think I try and have an idea of what the market maker thinks and what he's trying to do.
That's excellent.
So what I'm doing is, where are the retail traders getting in? That's what I try and look. I try and think, where would they get in? And mostly, if you're opposing to them, you will be correct. Like,
It's funny you say that, and it's an interesting caveat to the observation is some people think, where does retail enter? I think a lot of what Michael has described and a lot of what we're looking at is actually institutions, not retail. Like, where are the funds? Where are the huge funds? Where are they trapped? Where are their stops? Right? So those, just as a, further clarification versus retail.
If I may, I'm going to interject and make a little PSA. Okay, when I say retail, and this is correcting everybody else that wants to make these little videos and say ICT talks about how the market makers or the algorithms going after retail stops. Retail is such a small degree of the volume, whatever. Okay, let me explain to you what's going on. Here's the food chain, ready? There is smart money. They are an entity that you can't say, here they are, who's here, here's where they work from, this is what they do, this is who they trade for. They don't want to bring attention to themselves. They don't draw any kind of a billboard sign saying, here, we're from XYZ firm. They don't call themselves institutional. Institutional trading is retail. Everybody that's not smart money is retail. That's the part that nobody gets. When you go back to my old lectures, when I'm teaching institutional sponsorship, am I saying that institutions are the ones that's pushing price up or down? No, I never said that. But their participation allows smart money to cannibalize them too. If smart money is trying to make lots of money and be counterparty to the less informed people, why the fuck would they be trying to do it with the smallest degree of liquidity, which is us retail traders? Think about it. They're looking for the opportunity to cannibalize the fucking whales, the biggest portion of liquidity, you fucking jacklegs. Everybody out there has got their strong opinions about what they think I'm teaching or what I'm saying. You have no idea what I'm talking about. If you are not smart money, you are not them. If you're not them, you're fucking retail. You can call yourself institutional all the fuck you want. You're trading retail logic. All of them are trading retail logic. They're putting their stop losses above highs, below old lows. They're running after fucking price and chasing breakouts. Look at these fucking people. Study their shit. That's what they teach. And they charge all this shit. They take you to exotic locations. And then what are you still reading? You're reading price action through the lens of some retail horseshit. That's what it is. They're chasing momentum, and they're placing their stop losses in the same places I tell you they're going to put them in. They're moving their stop losses the same way I'm telling you they're going to do it. And all these people that make courses, they're ripping off what they think these institutional Goldman Sachs boys, the former market maker for XYZ. I was in the city. I didn't really learn anything until I went to work in the city. You didn't do shit. You haven't done anything. You made money on a reality fucking show, and now you're fucking putting people in a fucking a trading mill, making them think they're institutional. It's fucking, the institution is the fucking psychiatric ward. That's the institution you need to go to, because the shit you're teaching people, that doesn't make the market go up or down. So anybody that's not smart money is retail. Everybody but them. The people that make the market go higher and lower. It's rigged. Look at everything right now. I promise I'm only giving one more minute. But look at everything. We're discovering everything is fucking rigged to the gills. And yet these fucking clowns still want to argue. The biggest fucking casino in the world. And they're not going to rig it? They're not going to rig that? But this is the safest place still. They can fuck with the elections. They can fuck with everything else in the world. Everything. They can fuck with medications. They can fuck with your taxes. They can fuck with everything. But they won't do anything with the stock market. That's off limits. Come on. But anyway, I just want to make that interjection and make sure that you understand that when I say retail, I'm including Goldman Sachs. I'm including everybody else, because they're not smart money. They're fucking clowns.
I love that. So we're talking institutional funds with the allocation and placement of retail logic. That's not us, guys. That's them. That's big players. We're the ninjas that are coming in as ghosts in the machine, as our way of applying these concepts algorithmically to what these retail fund logic clowns are doing. right? We're literally, that's what makes all of this so great, is the precision that we have, the logic that we have, and where and how you can see what they're doing. They can't hide from what they're doing. You go back to 2022, what's the analogy? An elephant in a swimming pool. Why? Because you cannot stop what they are doing. And all you have to do is be able to read it. And that's what all of this is about, is how it works in your hands. So we'll get back to that right now. I want to bring up my boy, Dr. Tony Trades. Dr. Tony Trades, been in my DMs quite a bit.
Hey,
Hollered
kid.
at him. Yes, sir.
Did we just completely shove the guy I interrupted off? Like he didn't get a chance to say anything.
Oh, wait, no, did I? Bro.
I still had loads to say.
Mate, let me just tell you something. I've got ADD, and it's absolutely horrible, mate. And I just have this thing where I just be talking to somebody, and I'll just go to somebody else. So I apologize, bro. I'm sorry. My bad, MB. Thank you, Michael. I didn't mean to steamroll MB like that.
I just wanted to clarify. I've got one more thing just about tape reading, but so the market makers, they're targeting the big institutions. That's what they're aiming to get. They're
Absolutely,
to take them out.
That's exactly who they're aiming for.
Perfect. And yeah, and with the tape reading, I was just thinking about it. So I use the tape reading to build my confidence in my setup. So with this setup, I've just been literally every day tape reading. Sometimes on my favorite sessions, I would trade, but the other times it's built to build your confidence in your setup and know exactly what you're looking for. Because most of the observations come from the tape reading. Most of the time, people get too involved with the money aspect when you're actually trading. So their mind's too focused on making the money. Whereas with the tape reading, your focus is on price, like only price, because there's no money involved in watching something. It's just price. And you've got to look for these little things that appear in your setup and the little things that repeat over and over and over again, which makes it lock in your brain. And even though it puts, well, I wrote this down. I've completely lost.
No, you're crushing it, buddy. I love that. You're making really, really good points. I really appreciate what you're saying. I do.
Tape reading is to identify what makes a bad move more importantly than what makes a good move. Because I've learned, I've tried to find all the good moves, but it's more important to find which moves don't work instead of which moves work. Because if you can find the bad ones, you're gonna lose money a lot less than you're gonna ever need. So that's what I think about tape reading.
That's a very valid point. That's a very valid, and that's the takeaway I want people to recognize. It's not simply discovering that how many times you can be right or wrong, but eventually developing the skill set to recognize the setups that don't yield the same directional probability for your trade to pan out. Because there are signatures that you can see happening real time. I'm calling them out as it's happening. So if either I know the future, or I'm rigging the market myself, or these concepts work and they give me an edge, and I'm transferring that logic to you. And because it's a third I'm acting on, I'm hoping that you're picking up on what I'm putting down by saying, this is what you can learn to avoid problematic trades. And by doing so, and then never engaging with them, or as little as possible, you can do more growth to your learning curve and your equity curve, and far less damage and drawdown, because you can avoid the problem trades that most other people would just fall victim to.
Man, MB, I just want to say you did a really great job, and I'm really glad we got that recorded, because you did a really, really good job of explaining, I believe, as Michael just stated, really the spirit of all of this. So really well done, mate. High five. And we are wrapping.
Cheers, mate.
We are wrapping up here. I'll come back to you at the end, MB. I wanted to holler at my boy, Dr. Tony, real quick. I know he's got some good insight here.
Yes, I'm Tony Ratliff. I'm 57. I've been trading ICT concepts for 4 years. And I want to point out, I still don't have a specific model that I love. I like a lot of them, and I'm still evaluating them. But my question today was, when Michael opened the live stream, he said that he was neutral. I'm going to ask him, looking at the new WOG today, at the 8 o'clock hour last night in the futures, it started moving up and never came back. And at 7, it crossed, well, right around 7, it crossed over that 50% mark. Michael, is there a tell there in that time frame of the Asian and London session that would lead us to indicate that we're heading up to the top of that new WOG high for today?
Okay, bear with me because I gotta scroll back on my I gotta scroll back on my phone while I'm listening to you. So you're asking me about the NWOG, and at what time last night? 8 o'clock.
So at 8 o'clock, basically it dropped a little bit and then it just took off and it stayed up there all through the rest of the Asia session, all through the London session. They never let it come back down. It never came down and grabbed any stops until after 7 o'clock. Then it dropped down, grabbed the stops, and then took off again. But my question was more of that NWOG was halfway filled back in by the time the 7 a.m. session started. Is that an indication to you that we're heading to the top of that NWOG chart or NWOG gap?
Yes. Now you're talking about the 7 a.m. during pre-session time that we usually look for stuff. Yeah, that was absolutely indicative of it. And you can see how they clear. I posted a chart where the sell side liquidity was purged. That right there was a lot of it has a lot to tell you about that happening. They created those relative equal lows during the London session, and then at 8 o'clock during the pre-session hours, they dumped it quickly. They dropped it all the way down there to get those, and then straight from there, it's been running right to top of the NWOG and then higher. So that absolutely is indicative of running it, keeping it. Just because it ran up high like that, most people would say, okay, well, it sold off in pre-session hours between 7 o'clock and 8 o'clock. It sold off. It created that little high, and it probably won't go back for it anymore because look how far it went down. But when you look for these relative equal lows and you think about what we opened up this new week with news that all the peace deals fell through. Well, that's going to be translated to, oh, this is going to be bearish for the marketplace. So what do? They give the entire daily range for probably 2 days at the open last night at 6 o'clock. And then right from there, anyone that's trading Globex, they're thinking it's going to probably go lower still from that because this is an extreme gap. Sometimes it does. But then they just walked it right back on up in there and then pushed it so far, but didn't completely close it in and then tanked it. That is like a double whammy. It scares everybody. Like, oh, I'm not trusting it. I don't think it's going to go higher because look at it. You can't hold on to that. And it whammed for those relative equal lows. So anyone that was already on side off of those lows, they got taken out. They were completely removed from it. So if the seat is so good that they got to unseat you, that tells you something. They're willing to pay a premium. They will challenge the perception of everybody around the world that trades just to knock those people out right in front of you, and then take those positions over and then start adding new longs as it goes all the way up to where we're at now. I'm not sure if that answered your question, but that was my response to what you said. That's indicative of how they do it.
I love it, Tony. I hope you caught some of that. I mean, coming out of Asia, what you're looking for, these different price runs, how you mentioned it coming out of 730 and how they ran them lows like that. I mean, that's prolific. That is a profile. And those are things that we would look for or anticipate.
We're going to 12:15.
Yes, sir. Let's get Austin up here. My boy Austin's, I know he's got some good stuff. Austin, you're up next, G. I'm doing
How you doing?
I'm doing fantastic, brother.
My name's Austin, 38. I'm in South Carolina. Been trading ICT concepts about 3 years or so. My question is about the quadrants. And if you've answered this already, I'll be more than happy to go back and listen to it because I was a little late to the party. But when we have quadrants, and let's say, for example, we're looking particularly at 25 and 50% of our quarters, right? You mentioned that if you divide that 50% of the quadrant will give us an event horizon, right? And I know that 50% mark would be exactly 37.5, which is where the octant comes from, right? So that would be the 8th level. So basically 25, 37.5, 50. Okay. If I take 2/8 and I divide that, that gives me a 16th right at 50%, right? Which is an event horizon scenario. So my question is there a method to which if I keep dividing these things and getting the fraction of price, fraction of time, fraction of numbers, can I see something that would indicate what the next move is? So if I can give one more example. So if we push up in a range, let's say we divided the new weekly opening gap today, right? We put our eighths on it. And let's say we push to 50% and price is staying beneath 50%. The bodies are closing beneath. We know that's a sign of
So
bearishness,
order
right?
flow. Order flow is bearish based on your measurement. Yeah.
Correct.
Okay.
All right. So we're staying beneath 50% of this big range here, right? In between 25 and 50, if I divide that and I'm staying beneath 50% of that one, so that means now I'm staying beneath 50% of the eighth. Obviously, that's telling us we're even more bearish than what the initial one's saying. Are you with me? If I keep dividing these and they all are staying beneath 50%, that obviously should say that's extremely bearish.
You're
Where
on
I'm
side
getting
if you're
lost,
bearish. Yes.
correct. Where I'm getting, I guess where my question is coming from here, now that I've explained all of that. If we hold, at what point do we realize how bearish or bullish we are in this theology? Does that make sense? So if I've divided it 3 times, but on this third one, price is actually closing above 50%, is that an indication that I'm going to text the next bigger level, or am I reading too deep into it? Does that make sense?
Well, you're going to have 3 levels. Your defense is you have to have 3 PD arrays from where price is right now at current
Right.
market price at any given time. Go back 3 PD arrays. It might be an octant. It might be a quadrant. It might be an order block that agrees with these levels. The P level has to be associated with these gradient levels. The importance of it is knowing if you're on side, yes, but more specifically, when you don't have these levels on price action and you're watching them create these little tails or these little wicks while price is running and the little tiny little retracements, that go back against your underlying position you're holding, as long as price goes back to those levels that are gradient levels and they're not laying the bodies across them, if it's bearish, it won't lay a body on it. It can wick to it, it can wick through it, but the bodies have to keep telling you the narrative is still you're on side. So you're constantly getting real-time feedback with these smaller little measurements because it keeps your focus on trusting what's being delivered at the moment, and don't try to look for a reversal. Don't try to time the reversal. Stick to the trades you're in. That's the real benefit of having these things on your chart, and also qualifying PD arrays that are on real specific time and price delivery.
That makes sense. So what you're saying, that it actually was leading right into my next question. So if we have a body that does lay on top of one of these levels, is that an indication that we're going to test the very next one?
It
So
could
if we
be
have
an
a body
early
that
sign,
lays
like we were
over,
using that analogy today, the canary in the coal mine. It could be an early
right,
warning sign that you have to start demanding price get back in line. It needs to start showing you something. Otherwise, you could be in a position where you may have to take some of the position off because it may be warranting that. Or it could be like, I'm going to close the trade. I'm not interested in holding it now because it's showing my first sign of potentially reversing. It can. I don't want to give that much to everybody in one grand scheme because then I'm shaping your model. Then I'm shaping your perspective on it.
that makes sense. So when you mention about, we count 20 days back on the daily chart and we find our high and our low of our dealing range there, and we divide it by our quadrants, right? And you mentioned that in between 25 and 50% and in between 50 and 75%, in between those quadrants is where the best PD arrays are going to form. What takes precedent over the other one? If I grade that range itself or the actual PD array within that quadrant to grade that PD array?
The actionable point, if a PDA forms and you're implementing that as a trade mechanism for entry or targeting or a pyramiding and new position to an existing position, as soon as you start adopting that PDA array, then you're measuring that. Then that's the proving ground. It's not the gradients above it. You now have an actionable point. So your reference has to be framed on that context, not something above or below. You went to the business of finding that key level. You're using it to get into a trade, or you're using it to frame a trade. Now it needs to hold its own weight.
That makes sense. That makes sense. Okay, one last thing. So, and it's still in context here. You posted on Twitter last week an image and you asked if we saw squares or circles, right? When I think about these gradient levels, is there a way we can grade vertically with time that will match this price that gives us a grid of a specific price that we're looking for?
Yes, it'll be in the books.
All right, I thought so. Cool. All right, thanks, Michael. I appreciate it, man.
Good questions, man.
Man, Austin, cooking with chicken grease there, my friend. Love it. Dr. Tony, we wrapped up with you. You good, buddy? Johan? Parm, we'll bring up Parm. We got time for one more. It's been really good so far. We've stayed close to some folks that we are a little more familiar with their aptitude towards the concepts. I mean, Austin's a baller. He's been around. Parm, you there, bro?
Yes, sir.
All right, jump in.
First of all, yeah, can you listen me?
Yes, sir, we can. Just jump in.
Okay. So first of all, I wanna say thank you to ICT and you. I found I'm speaking first time, so I'm a little bit nervous, right? So I'm like a 30 years old, so I'm from India. I find ICT like I go into trading in 2024 around like June, right? So for 2 months, I do like the retail stuff, and then I go into like ICT. I find ICT, and then I don't know like how to like use models and all that stuff, right? So I go into his channel. Sometime I like tweet it to him. So I just see everything like whatever I can see. Like after 1 year, I find out like how we can use those things. So now I'm like basically focused on like the opening range gaps, like regular trading hour gaps, and I use them like to go up and down.
Nice.
Yeah. So
Hey, you're doing
I
great, by the way.
yeah. So the key like I want to share an observation, right? Like from today, like from today price action, when we go down and when we are waiting for like the 951, like 950 macro, right? So I always think like we need the makers are always ahead of us. Like what narrative? Like why Michael always say like we need to make a narrative like in advance, like what will happen, how we will take actions, right? So what they will do, like if we are there, we take the sell side. If we are thinking like we will go to like the half gap fill and the full gap fill, but by the time we reach like 951, they already like reached there. Like the target is already like done. So I was just observing that, like tape reading that. So this is all.
Okay. Yeah, that's a good observation, buddy.
Yeah, yeah. So I just want to say like thank you to like I find you and Michael like when I was lost in all that stuff, right? I don't know like how to use anything. Then I listened to that like Twitter space, which I remember like hang out with one and only, like with Michael
Oh,
and
yeah,
you.
that was a good one, bro.
Yeah,
That was a good one.
yeah. I remember those Twitter spaces. Like at what minute, like what ICT speak, like what's the topic, and the one that from Michael, like the under into his marvelous light. So I wanna say like thank you God that we got Michael right here.
Yeah,
So
yeah,
I was
buddy.
just yeah. So then like at that time I was got like little emotional things. So I like Michael always say like if you know something for learn something from me, if you want to say thank you, just teach other people, right? So I got like 5 or 10 of my friends. I told them, and the same friend from those friends, there is a friend who put me into trading, like into the retail stuff. Then I go to him and told him like, this is the man. This is a YouTube channel. So his name is Michael. He's doing these things. Hello?
Yeah, good work, buddy. Good work. I like it. I
Yeah,
like it.
yeah,
Okay, hey, we got a few more minutes here. We're wrapping up here. I appreciate your thoughts, your 2 cents here, Parm. We got one more. We got time for one more question here. So,
yeah. Can I ask like the one question?
okay, sure. If you got a question, mate, jump in.
Yeah, yeah,
Let's go.
yeah, yeah. Like maybe like Michael, like what I got in my mind, like from the PDRS, like from model 2022, like I observed the thing, like that thing, like the market structure shift and the two highs and lows, right? Like if we run a high above a high and make a new high, like we got like two highs
Yeah.
and like there is like a fair value gap if we got displacement, right? So we got like those three PDRs behind
Okay, wait.
stop,
So
like
you have
from
you
the
have
stop
so you have two relative equal highs
and a fair value gap.
and a fair value gap that's a
So
displacement lower.
yeah, so we got like can we consider that like the three PDRs from that stop loss, like the same thing in 2022 model?
Using relative equal highs as one of them.
No, like Michael, like we take like high, like sell like the buy side liquidity, right? And we make like the new high. We got two highs, then we got a displacement down.
Stop
So we got a fair value gap there. So if we go short from that fair value gap, like to the downside, can we consider like that one high that is already run and the another high and the fair value gap? Can we count them as like a three PDRs from that stop loss, right?
I
That's
wouldn't
my
count the previous high that gets traded through. I wouldn't count that. I would use the high. I would look and see if that high has a wick. If it has a wick, it would be the consequent encroachment of that wick, and then
okay,
any up close candle that formed after that wick on the highest high, I would use as
okay,
a bearish order block. They would be my three.
okay, okay. Instead of like using two highs, I can consider like the one high and the order block, right? Like the bearish order block over there, right?
You can, yes. It's all. I
Yeah,
mean, we're making a hypothetical scenario without actually having a chart
yeah,
there. But if you're using the fair value gap as your entry, try to
yeah,
look for three PD arrays above that. Not just because the fair
yeah.
value gap in and of itself can color outside the lines. The stop is on
Okay, okay,
candlestick number one. So you don't want to use that. You want to use something that's prior to that. That's going to give you framework to say, okay, this trade's good because it has three levels of defense behind that. Because everything can
yeah. Got it.
trade through by a wick and still be good. Does that answer your
Yeah,
question?
yeah. That's it. That's it. Thank you, Michael, for
You're
all
very
that.
welcome. Thank you so much for your kind words
Okay,
too.
thank you. Okay, thank you. Thank you, Kit, for taking me there.
Yeah, high five, buddy.
Okay, okay, brother.
Okay, we're coming to
Okay,
an end here.
okay, thank you.
We're wrapping up. Moverse Dgen brought you up. What you got? Maybe. Looks like looks like we're gonna wrap up here. Johan, you can have the final words. We were gonna bring up Moverse to see if he had anything, but Johan, I'm sure you'll have a good last question here.
Okay, so Michael, you taught us the PDOA to connect two fair value gaps with a volume imbalance. And my question is it limited to one connection? Because if I noticed if I try to extend it one more time, when there's another volume imbalance, it doesn't give me sensitive levels. So is it limited to one connection?
I'm not sure I understand the definition of one connection. Event horizon is half of anything that you would utilize to either enter a trade on, target, or base a stop loss around, or a partial exit. Like anything that would be trade related, entry or exit, or stop base. Anything that you would define in any element of a trade. If there's a range between what's available in the price action and the range that you're trading inside of right now, you divide these little empty spaces, these little voids where it doesn't look like it's really showcasing anything. But then when you measure in between, you'll find many times that these price runs go to this midpoint that's like ghosting between what would otherwise be obvious. So I don't know what you mean by multiple or beyond a single connection. You're only looking for a PD array, a key level, and if there's a span of range between that and the one you're looking for, that midpoint is many times going to be a responsive area. It could draw to it, or it could be a very new turning point to cause another continuation of the existing price run. Don't try to complicate it more than what I'm showcasing. Let's put it that way. Like you're all looking for some kind of mystical way of applying it, and it's just a straight, simple little thing. Like whatever you're seeing in the range that we're inside of right now, whatever dealing range, whatever recent high to recent low, you're in that range. It's either going to go higher or it's going to go lower. That's your premise, or you're just going to go sideways. So you can do nothing. But if you have a directional bias, either it's going to overlap that range or it's going to leave that range. Doesn't matter. Whatever PD arrays, whether it be a liquidity pool high, liquidity pool low, imbalance, the NWOG or NWOGs within that range, all of these things could be subdivided into the half points. Okay, the halving of everything technical is a science in and of itself. You can take this to a crazy degree, and you'll find all kinds of wonderful discoveries. I spent lots of time doing that, but I ended up chasing a lot of things that I couldn't implement as trade related. So I just brought it back to, how does this relate to the dealing range I'm in right now? And is there anything, has price revisited that area between these two specific PD arrays or these specific pools of liquidity? If they haven't traded there, it's a minimum expectation or a low-hanging fruit objective. And then when you start combining things, sometimes it'll be actually an entry model. Other times it'll be just a confirmation of the existing price line. So if there's one thing I can try to encourage all of you to do, and it's not because I'm trying to hide something of benefit, I'm actually helping you try not to chase too many things, because you can chase ghosts all through all kinds of different walls in this castle, and it doesn't necessarily mean it's going to take you somewhere where it was helpful to you. Wonderful studies for pastime, but taking it to a point where you can actually trade with it and use it, it's better just simply going back to where you're at in the range, what's available, and if that midpoint hasn't been traded to, either by retracement or created a PD array, chances are it might do it.
Yeah, that's helpful too, but I posted it in the comments. But if you want to go, then it's fine. I don't need to take my time. But it wasn't what I meant, but it's fine. It's my bad. But it's in the comments.
I apologize. I thought I understood your question. I apologize. I'll spend enough time to satisfy your question. Can you rephrase it again?
Can you open the comments? I think then it's easier. But I can.
Is it the little bubble? Is it a little bubble?
Yeah, the little purple bubble. I'm looking for your chart too, buddy.
I can.
It's at the bottom. Yeah, it's at the bottom. 1 minute ago. Like scroll almost to the bottom, Michael. Towards the bottom, you'll kind of see it's almost like in the middle. If you click that button, you'll see Johan's got 1, 2, 3. He's got a couple charts there.
No, it's the same one. The same one I spammed.
Okay, so the 1 minute ago, it's the same chart.
Every chart from me. I spammed the same thing.
Is it ES?
Yes.
Yeah, I'm looking at your chart. It has 2 rectangles on it, highlighted in gray.
Yeah, the upper rectangle, this is the new PD array you taught, with the 2 fair value gaps connecting with a volume imbalance.
I taught that?
Yes.
Or did I display it?
It's 100% from
okay,
you.
Make your question. I'm being facetious. What's your question?
Can it be connected one more time? So if there's another volume imbalance, we connect it one time further.
So is it like it's evolving? Is that what you're saying? Like it's becoming a greater or smaller range because of that?
Extending more.
Yeah, that would be the Johan. I think you like the term cascading.
I don't know that in English.
Okay, that's fine. Trying to help you out.
I think he means one more candle with a split in it.
I mean, Michael understands the term cascade, so it'd be a step logic. So,
are you asking while that range is forming, if it created another candle with another volume imbalance, would I incorporate that in concert with the previous ones?
Yes.
Yes, that's something that I can't answer in great detail in the small span of time. But yes, that's a reoccurring thing. It's like an order block. An order block is a consecutive run of candlesticks that makes the last ones. But if you have a big blow off one, it cuts right to the chase that you just go to the open or close of the last one because it's the biggest one.
Great.
But if they're all uniform in length, you can consider the entire range. Well, when there's running, when the price is under a run, it's protracting, going in one direction. If it starts building another candle and it creates another volume imbalance, you can incorporate that the same way that you would incorporate consecutive up closes for a bearish order block or consecutive down closes for a bullish order block.
Okay, thank you. It's insane how precise in this example. It's everybody in the lower half. Okay, thank you.
I think we're at a great place to close, but I just wanted to add, just from a topical standpoint, if you were to take 3 days highs and 3 days lows, and you were to take one of the 3 days versus the 2 other days, and where price had gone until right now, we would call that the event horizon, which is interesting, right? So, yeah, I think we're
I'm
at a
looking
great
on my
place.
phone.
Yeah.
And I may not be seeing it as clear as all the rest of you, but if you look at the 15-second chart and
Yep.
the fair value gap that we were studying in the live tape reading, we just recently now and traded into it, and you see price reject it aggressively to the upside. So it was respecting that lower half around the consequent encroachment, and it sent it above aggressive, and now we made a higher high on the day. So again, just because it's in a smaller time frame, sub 1 minute, doesn't in no way, shape, or form indicate or I guess promote the idea that it's just noise. If anything, I'm hopefully dispelling the myth of lower time frame charts are noisy. If you want to say a well-tuned orchestra playing absolute masterpieces is noise, well, then that's a matter of opinion, because clearly we can see that there's things repeating on the same logic, the same reference points, with the same directional bias. Just waiting for those things to present themselves, and then does it fit the narrative? Does it support the idea? Is there discount sensitivity in the upper half? Does it stay out of the lower half? Does it displace aggressively away from that level? And we've seen multiple times of that today. And in a market that right now is on a 1 minute chart, range bound, it's just consolidating. Otherwise, they say the chop is real, or it's consolidating, it's noisy. F this price action. This price action's ass. Just go down to a lower time frame and you'll find all kinds of setups. They're not hiding from you. They're only hiding if you don't study, if you don't tape read, if you're not looking for them with a earnest passion, trying to get to a model that repeats. You can take that same model, that cookie cutter, and apply it to every time frame. In the lower time frames, sub 1 minute, you get lots of examples to exercise on, lots of examples to practice on, to build confidence, trusting that, wow, this thing, it really does work. It works. And just today, if you would have just caught any one of them, even if you would have got stopped out trying the first one, it still yielded a net gain day if you did it in terms of experience and learning. And if you can't see that, the rest of the lectures this week isn't going to help you. It's just going to be it's going to feel like a disconnection. So today was to show you that specifically dealing with 2 different ranges of a gap and efficiency, and then looking for liquidity and how price will run for that liquidity against the narrative that the opening bell last night extremely suppressed lower pricing, upset everyone that's long, and inspires new bearishness. And look how quickly they came back to say that's not going to happen. And you can't fight that when it does that. Don't stand in front of that freight train because it'll roll over top of you. And some people insist on doing that kind of stuff. And the only way you're going to learn not to do it is by safely encountering price action in a manner where you're not risking anything. You're not monetizing the outcome. You're not going to punish yourself financially if you're wrong. And just lower your expectations on yourself in the beginning. It's a normal thing. It's a healthy thing. And I hope today was, hopefully very constructive for your learning, inspiring, and hopefully it'll be, a good foundation to the rest of the week.
On that note, everybody, have a great one. Thank you, Michael. Thank you, Pit Munch. Thank you, Austin. Thank you, Tony. Market Oracle, Andre, Johan. Thank you, everybody. Thank you, Andre. I see the high five there. Great job. We'll see you guys on the next one. High five. Cheers.
Thank you, Kit.
Yeah, thank you. Bye.
Thank you.